Thank you so much for joining. Today with us, we had Charles Seaman, one of the best underwriters in the country. We're going to talk about the best practices in multifamily underwriting. Here at Cashflow Champs, we are helping investors gain financial freedom through passive investments in real estate. Charles, take it away.
Yes, Prashant, thanks so much for the introduction. So for those of you who joined us a few weeks ago, we went over some of the basics and some of the starting points when you're looking at your underwriting. Today, we're going to go over a little more. So underwriting is obviously a very encompassing topic. There's a lot to discuss. One of the things I'm going to talk about today is some of the different data that you might look at when you're underwriting a deal. So what I have on the screen is actually a CoStar report, and this is actually for a property we've looked at and that we actually own. And there's a few different things we look at. So aside from just the existing numbers, what you're going to look at is things that, let's see, I'm having an issue here. Let's see. You're going to be looking at some things in the market as well. So you want to understand the strength of the market. You want to understand where the comps are, and you want to understand what the probability of you being able to achieve the desired result is. So one of the things we always like to look at, apologize, I'm having some technical difficulties. It's a good thing we're not in the tech space. We like to look at some of the key metrics. So we like to see where other properties are selling. We like to see what similar properties are renting for. We like to see what type of new supply is hitting the market. So getting that type of information can impact your underwriting because it could play a factor in how much you're able to effectively push rents over the whole period you're looking to own the property for. So with this particular report, what it's showing us here is some of the key indicators for different properties. And with CoStar, the way that they rank their properties, they do it on a star system. So the more stars, the higher the quality asset is, and the less stars, the lower quality. So depending on the property that you're looking at, you want to make sure that you're using good comps. And when I say good comps, I mean similar properties. So if you're buying a property that's a 2-star property, which many C-class properties tend to be, then a lot of times you're going to be looking at it and you'll wind up wanting to compare to other properties of similar vintage and similar construction. If you're comparing it to a much newer property, it's probably not going to have as great of an effect, and you'll probably get very skewed results. So let's look through some of the data and talk about how it could impact your underwriting. I apologize, I'm having some technical difficulties. Let me close this out and we'll reopen it just to try again. Let's see if this does better and solves the tech issue. Okay, let's try this again. Take 2. Okay, so what we have here is a submarket report for the market that the property is located in. So what it's going to tell us is all the data we were talking about. So if you're looking at a property, and let's assume that you have a 2-star property and the average rents that you're seeing at the property are $950. Well, what this data here is telling us is that similar properties in that same range have a 6% vacancy rate on average and an effective rent of $1,141. So that means if you're projecting forward in your underwriting, there's a high degree of probability that you'll be able to achieve that higher rent. Conversely, if you have a property that's already around that range, it may be a lot tougher. Now, keep in mind, guys, even as you're looking at properties in the same submarket, submarkets really can be very hyper-local, and you could see changes in a block or 2 radius. Sometimes you might have a particularly bad block. Maybe there's a lot of crime. Maybe there's some type of issue that's making it less desirable. And that could actually make it less desirable, and meaning you're going to get less rent than comparable properties in that same area. So just understand the market you're in and understand what you're looking at. Understand historical trends. I think one thing that a lot of people have been doing the last couple of years is they've been looking at data from just the last 2 to 3 years. And in most historical perspectives, that's probably not a bad idea because the most recent data is always going to be the most relevant. But you need to realize in the last couple of years, we've had an anomaly. And the reason we've had that is because of the amount of currency that's been added to the currency supply in such a short period of time. So you want to go back over a longer period of time, maybe a 5 or 10 year trajectory, so that way you can see what the growth for that market has looked like traditionally over that time. So some of the things we see here are vacancy rates. So how does this impact your underwriting? Well, what it's telling us here is that 4 and 5-star properties, they're in blue. It looks like they're going to have pretty low vacancy rates, probably somewhere around the 7.5%, 8% range based on what we see on the chart here. But then you'll notice that and this is actually forward looking, so that's up to 2027. Right now, we're probably more in that 7% range or so. It's a little bit lower. And for the 4 to 5 star, even less than that, maybe 6%. But then you'll notice at the 3 star, there's actually more vacancy. So why is that? Well, earlier in the report, what we saw is that there's more supply in that space. So with anything in life, whether it's real estate, whether it's running a fruit stand, regardless of what it might be, supply and demand is the basic economic principle that's going to govern what people are willing and able to pay for something. So in this case, if you're underwriting a 3 star property and you see that historically the vacancy has been a little bit higher in the submarket and is projected to stay that way for the foreseeable future, then you might want to use that in your underwriting. So just keep that in mind. Not all markets are created equal. So you also want to gauge the sales comps. That's going to be a key thing. And while some people will tell you that you don't really use sales comps in multifamily, I would personally disagree with that. While you are using the cap rate and basing it on the income, you very much want to get a picture of what things are selling for in the area. A lot of times buyers and sellers will have a kind of a psychological threshold of what they're willing to pay for a certain asset. So what you can see here is some sales data that they provide in the report, and they're showing the blue line, which is North Charleston, the submarket that this report is for, and then the Charleston market, which is the MSA, so that's in green. So what they're showing us here is that the submarket has a lower price per unit on average than the MSA, and that's going to be data you want to use. So if we're looking at a property right now and you're buying a property substantially above where this number is, you may want to think twice. Now, does it mean automatically you shouldn't do the deal because the basis is a lot higher? No, because keep in mind, this is a blend of all different asset classes. So there are going to be some that are higher and some that are lower. So if you're looking at an A-class asset and it's a superior asset to many of the other ones, there's a good chance you probably will pay a higher price per unit. But just make sure that whatever decisions you're making line up with the data you have. So what else do you need to look at and really confirm aside from just market data, rental information, supply? So some of the other things we talked about were insurance. And I know for us personally, insurance has been a very big factor recently because the insurance market is very volatile. There's a lot of moving parts in the insurance industry right now, and things are changing on a rapid basis. So sometimes the premium you wind up with is very different than what you first started out with. So you want to make sure you're being diligent and taking as much precaution as you can. As a starting point, one thing I do is I use this site here, ratemap.org, and this is actually run by an insurance broker that we've done some business with. And what they do is they update this site every month. So you can click on the region that you're looking to buy property in. We buy mostly in the Southeast. So it's going to tell you where rates are right now. And then you'll see that change from location to location. So the Southeast is going to be different than the coastal, and that's going to be different than Florida. So things are changing on a rapid basis. Make sure you're getting good information. Now, when you're doing a first pass at your underwriting, using something like this site here is fine. Even if the number on this site is comparable to what the seller is paying, I would tell you always factor in at least a 20 or 25% increase. Now, if you've been following the industry for a while, that number probably sounds a little high to you, and it is. That's to reflect the volatility in the market. And then also, if it's a deal you're seriously in contention on, make sure you're actually reaching out to an insurance broker and having them put eyes on it so they can give you a good number to use for your budgeting. So what other things do you want to look into? Well, the taxes are always a big one, and you have to make sure you confirm the taxes. So typically what I do is I go to the county assessor for wherever the property is located. I reach out to them and I tell them that I'm looking to buy a multifamily property, and I tell them, kind of this is what the purchase price is, and give them some basic details. And then I ask them a few questions. The first one is, one, when do they reassess? Two, how do they calculate the reassessment? And three, will a sale trigger an automatic reassessment? So one of the things you want to really make sure of is that you understand how that process works. There's probably no line item that will impact your underwriting more than the taxes, because sometimes they can be very, very significant jumps. A lot of times I've seen them double and triple on these deals, and there's sometimes I've even seen them quadruple. So make sure you're doing your diligence on the front end, and that way you feel confident with the tax number you have to use it in your underwriting. What else do you want to check? Well, you're checking rental rates, you're checking sales comps, you're checking taxes and insurance, obviously financing. That's also a moving target. It's moving a lot less than it was last year. So that's a good thing. We're starting to see at least a little bit of stability. But for any deals you're competitive on, you need to be reaching out to a mortgage broker or a lender and getting real information that you can plug in. So a lot of times in your underwriting, you're going to use assumptions, And the underwriting you have is only as good as the assumptions you're working with. So if the assumptions you have are wrong, then the underwriting you have is going to reflect that. Just keep that in mind. So let's go through a kind of like a financing term sheet. I'll show you what one of these looks like, because this is something you're going to be seeing on a regular basis. Now, this particular deal we first looked at in late 2021. Market conditions have obviously changed a good bit since then. But what we had at that time was a quote for a floating rate loan, and these were the terms we have. So by getting this, what you do is you update your underwriting to reflect the market conditions at that time and to reflect the information you're getting. So what I would recommend is being on the conservative end if you're given a range. So in this case, you'll notice it says initial LTV 70 to 75%. You're better off assuming the low end of that range, 70%. Same thing on the interest rate side. So we were given a range of 3.35 to 3.85. So go on the high end. Be conservative, but realistic. So that way you're going out there and you're using good numbers that'll make you competitive on deals, but also not being too overzealous where it makes it very, very tough for you to hit those numbers. And then after that, it's really just a matter of going back to the underwriting and seeing if there's anything you can tweak. So you want to be in constant communication with the broker or seller, and you want to take that communication and just use that to fine tune your underwriting. Sometimes they're going to give you information as far as where the sale price really needs to be to make a deal happen. Sometimes you can talk through the underwriting with the broker or the seller and just explain to them what your position is and get their feedback as well. And then see if there's any room to further fine tune. One recommendation I would make in the underwriting is you don't want to max everything out. If everything has to go perfect for that deal to work, then you're probably putting too much pressure on yourself, too much pressure on the management company, and too much risk for the investors. So leave some cushion in there so that way there's room for things to go wrong. So that way there's no unnecessary surprise. I see we have a question in the chat box from Francisco. What is the difference between spread and interest rate and financing options? Good question. So the spread is what the lender is making. That essentially is their money. The index is what the actual financing is linked to. So for simple terms, the index is what the lender is borrowing money at, and the spread is the profit that they're making on that money. So obviously market conditions have changed drastically since this was December 2021, but you'll notice the index was very close to zero at that time. Depending on the index that the loan is tracking to, it's certainly going to be higher now. Long-term fixed rate loans like agency loans, they typically track to the US Treasuries, and shorter-term bridge loans usually track to the SOFR curve. So both of those would be substantially higher at this point. So that's really the difference between the two. And then when you total those numbers up, that's what your interest rate is for the loan. So if you have a floating rate loan, usually the spread is locked at the time that you close, but the index is the part that's going to keep moving and tracking whatever index is following. Great question. Why don't we open up for any more questions if anybody has? Put them in the Q&A box and we'll gladly answer them and talk through them. Who has questions about underwriting or any of the different components that go into it? Okay, so most importantly, guys, in closing, what I would say is obviously make sure your numbers make sense. You don't want to make an offer or buy your property at a number that you can't deliver on. So it's better to be conservative and miss a deal than it is to be aggressive and get a deal, if that makes sense. Now, the careful thing, and this will take some practice, it won't happen the first time out, but after you do this enough times, you want to figure out where you can get aggressive and where you can be conservative, but still keeping some balance in there. And that'll help you stand a greater chance of underwriting for success so you can actually win deals, but still be smart with them so you're not taking on too much risk. Prashant, I'll turn it over for you. Should we open up for some more questions here?
Yes. So Charles, we're going to talk about Archway. I'm going to share the.
Yes, absolutely.
If you can talk about Archway also, that would be great.
Sure. Okay, guys. So Archway, this is our current investment offering. This is a 506C, so it is for accredited investors only. And if you are accredited, we're glad to have you in this deal with us. Next slide, Prashant. Okay, so here's a few of the things we like about this deal. The best thing is the debt. And one thing I would tell you from personal experience, I'm sure Prashant would agree, the debt is really the single most important thing in these deals. If you have the right debt, you can often afford to make a few mistakes and still be very well positioned. If you have the wrong debt, you might be in a bad position from day one. So with this deal, it has a Fannie Mae loan assumption. It actually has two loans, a senior loan and a supplemental loan. And with those loans, they're both being assumed. They have about 7 years left on them. and they have a blended interest rate of 3.79%. And that really is the driving reason why this deal works. If we went out there and placed new debt on it, it would have to be acquired at a much lower price to account for that. The second thing is cash flow. Because of the great debt and the other fundamentals around the property in the area, we feel very good about having an average cash on cash return north of 7% throughout the whole period. Now, the opportunity with this deal is really going to be a management play. So we've actually purchased another property from this same seller in the past, and we understand that their properties usually leave a lot of room for operational upside. There's a healthy amount of tenants with delinquent balances, and the play is really getting those tenants out and then repositioning those units and renting them to better qualified tenants. So we expect most of that to happen in the first 12 to 18 months, and then that'll set the property up for a good long-term trajectory. And the sellers also put some good CapEx money. They spent north of $1 million in CapEx. They've upgraded about 60% of the units in some way, shape, or form. We still have more CapEx spending we're going to be doing, but it's giving us good bones on a property. One more thing worth pointing out, this particular deal is in Riverdale, Georgia. It's part of the Atlanta MSA. So for anybody familiar with the market, you'll know it's about 10 minutes away from the Atlanta airport, which is the busiest airport in the entire world. And that airport area is undergoing a major expansion. They have a big project called 6 West that's been going on. That's going to be opening up a lot of new businesses and a lot of jobs. And a lot of those jobs are going to be blue collar jobs. So the tenant base that's going to inhabit this property will definitely be blue collar. As you see more of those businesses open up and more of those jobs come online, you're going to have more and more demand for workforce C-class housing and less new supply coming online. So that means over time, as you have more people clamoring for the same housing supply, that's going to increase demand, which ultimately results in higher prices. Next slide. Next slide, Prashant. Okay, so here we have some information about the projected returns. So this is what it would look like if somebody was to invest $100,000 in the deal. So what you'll see at the very bottom right-hand corner, your total return on investment would be $92,573. Now, keep in mind, guys, this is a projection. This is not a guarantee, so just be clear on that, but a projection. And you'll notice that the member cash flow, which is the third line item, that's going to be steadily increasing each year. So in year one, it starts off low because we do have a lot of tenants that we have to evict. And then that gradually increases throughout the life of the investment. So you would receive about $36,000 in cash flow and approximately $55,000 on the sale. And that's an average annual return of 18.5% and an IRR of north of 15. Next slide. So here we have some QR codes. If you're interested in checking the deal out, the one on the left-hand side goes to our investment webinar. That'll give you more information. The middle one goes to our investment summary. That'll tell you the details about the deal. And then the right side goes to our investor portal. So that way, if you're interested, you can go there and review the offering docs and subscribe. Next slide. And here we have some more information about registering for next week's webinar. So if you're enjoying the content we're providing, you can click on that and you can subscribe to it. When you sign up, I believe there is actually an option to sign up for multiple webinars, so you don't need to register each and every week. We want to thank everybody for coming, and I'll turn it over to Prashant to close us out.
Charles, thank you so much for your time this morning. Thanks for jumping in. I was supposed to do this webinar today, but I was a little bit under the weather, and that's why I'm not coming on camera today. But I appreciate your time, and thank you so much, all. I mean, if there are any questions, feel free. We have a few minutes in the Q&A box. We are here for a few more minutes. I don't see anybody typing any questions, so I guess we are good.
Excellent.
Right.
Thanks so much for coming.
Yeah, thank you so much. Thanks, everybody. We'll see you next week. Thanks, Charles.
Thank you.